Smooth 98.1. It is gone past 6:30 for a Thursday morning, and this is Business Express on Smooth Breakfast with Victor Pepple
and Sope Martin. So now for the next 15 minutes, we will be discussing with Rotus and Tunde. Good morning, Rotus.
Hey, good morning, Victor. Good morning, Sope. Good morning to all our listeners, viewers. Welcome to the new month. Yeah.
All right. Now, there are several ways to reach us live in the studio. WhatsApp is one of them. 0809 4440981 is the WhatsApp number. Send us tweets at Smooth981FM, and we're streaming live at the moment on YouTube. It's Smooth981FM Lagos. We have a guest.
Yes, Babatunde Ogunleye, who's an equity research analyst with Stanbic IBTC. Good morning. How are you? And welcome to the show.
Good morning, Sope. Good morning, Rotus, and good morning, everyone.
Good morning.
Sorry, I missed out your name. Good morning.
Pepple.
Okay,
Say Pepple.
Pepple.
Yes, great.
Morning.
Welcome.
All right, so very interested in getting to the capital markets update with Stanbic IBTC this morning. And remember, you can leave your comments on WhatsApp, on Twitter, and of course on the live stream up on YouTube. All right, gentlemen, shall we get started?
Yes, I feel like I'm delivering a presentation. So we're going to be looking at 4 banks, time willing, Fidelity Bank, Zenith, FBNH, FCMB. If not for Zenith, all of them would have started with an F. But I guess looking at half year results for these banks, can you kind of give a summary of their revenue triggers and how well they did?
Okay, so just speaking in terms of the general banking sector, so the trend we've seen in this for this first half of the year is the fact that there's an improved interest rate environment, right? So where interest rates was in previous year is different from where it is now. So you see, what's it called? For instance, like Treasury bill used to be around 3% in previous year, and now it's trading around 7% now. So on the back of that, banks are able to like book a lot of saw an increase in terms of their investment securities, like interest income on their investment securities. And also it's also the fact that on their loan book as well, there was a repricing of their loan book. So previous year, there was this, previous year, because of the low rate environment, the interest on their loan was not quite significant as what we saw now. I think in terms of what we are seeing now is on the back of the MPR increase. So for those loans that are non-intervention loans that are benchmarked against MPR, we saw an increase in terms of the loan book for the banks, and which is due to the fact that there's an MPR increase, right? So they needed to reprice those loans that are benchmarked against MPR in order for them to be able to make enough spread. So that was what we saw in terms of their performance triggered. I think this was basically for FBN and then also for FBN and also for Fidelity. But for other banks like Zenith and FCMB, I think what we saw was the fact that they are trading their non-interest revenue, particularly coming from e-banking revenue, and also on their trading gains too as well, sort of help them improve their performance as well during the period.
Great stuff. As far as what are the banks facing?
Okay, so I think in terms of like what was the challenge that we saw like for the banks, I think the key thing here is to mention like 3 key things. The first is the high funding cost. The second is the increase in OPEC given the inflationary environment, and also the increase in taxation. From a funding cost perspective, I think what we saw there was the fact that because of the arbitrary CRR regime we had, so typically CBN would debit bank for CRR. So let's say, for instance, the bank has like a funding, the bank have like liabilities for their customers to be able to meet up with. A client wants to do a transaction and the client paid in like 6 million into the bank account. And then let's say this was done on Friday and the transaction was to be carried out on Tuesday. So the bank waking up on Monday has realized that CBN has removed 2 million out of those on the back of the excess CRR, on the back of the excess CRR regime. So for the banks to be able to close up the shortfall of the amount that was taken out, so they needed to go and raise funding, and which is what we've seen in terms of going to the secondary market, particularly taking expensive deposits to be able to close the shortfall of the CRR that's been taken from them. And I think the impact of that sort of put pressure on funding for the banks, and which is why we've seen an increase in interest expense. And this was the same across all the banks. The second one was also the fact that MPR increased. So for your savings deposit is benchmarked against MPR. So with that as well, that also led to an increase in funding. That also led to an increase in funding costs. From an OPEX perspective, I think it's basically driven by four key things: the high inflationary environment. Inflation is currently at 19.6%. And also you also have energy, high energy costs. For Zenith, I think Zenith recorded like 55% increase in fuel and maintenance costs during the period as well. You also have the banks trying to do more of IT, doing more of digital banking stuff. So they needed to increase their IT expenses to be able to improve the automation. So we saw that increase as well in IT expenses. And also the final one is also the regulatory fees as well. So if you look at the OPEX bucket of the bank, like the regulatory expenses seems to be very, very quite high. That's AMCON and NDIC charges as well. So we saw increase on that as well during the period.
That's a lot of headwinds. A lot. Fidelity Bank made the news this week. Some people got things confused. They thought they purchased Union Bank here in Nigeria, but apparently it's Union Bank UK. What's the significance for Fidelity with this? Why they do this?
So I think for me, like, we're not really optimistic about this, and it's given the fact that if you look at when Union Bank discontinued their UK operation in 2020, and if you look at in terms of what it has contributed from a revenue and asset perspective, from a revenue perspective, it basically contributes around an average of 3% over the last 5 years in terms of the contribution, and assets is just roughly around 9%. The basic bulk of it is coming from the Nigerian business. And if you look at the profit trend, like it's been making losses since 2019. It made a loss of 4.5 billion in 2019 and 6.5 billion in 2020. So the key question here is like, why do you intend to acquire this particular business, given the fact that there's much needed turnaround strategy that needed to be done in the UK business? And I think based on conversation with management, is just to improve their trade settlement business. The bulk of their trade settlement business seems to be in the United Kingdom. So I think the acquisition just give them the leverage to be able to like boost the trade settlement business for the bank, basically.
All right, thanks for explaining that. Diesel. Oh, I think you've already mentioned this as far as operating expenses, but the diesel, high diesel costs, is that still impacting the operating hours of the banks? I think they're still closing earlier than they did. Is that right?
Yeah, so I think for some banks, they had to adopt the strategy of closing earlier. And for the other banks, what we've seen is that they're trying to merge operations, right? So in a situation whereby you have like two branches in the same street or in the same region, it's just more of moving operation from one bank to the other region to be able to save like energy costs, basically. And they are also trying to encourage more of customers doing more of the digital transaction as well.
I have a bank that, my bank, when I signed up with them, I thought I was going to just be doing it the old school style. But every time I went in there to the bank, they sent me back and said, do it on the app. At first, I was like, what is this? But it has become second nature and it's absolutely fantastic. I no longer need to go to the bank, no longer need to be in the long queues. Everything is done.
Yeah, it's digital, yeah.
Well, what about, I could actually just to piggyback on that point Sope brought up, Tunde, I guess, what does that mean for jobs and, physical individuals in branches? Will you see less branches going forward as the banks adopt more IT and more digital pathways for services?
So I think to an extent, there's going to be the concern of like changing role, because as you do more automation, you are going to expect like there's going to be a reduction from a personnel cost perspective. And I also think the other thing they're also trying to do is the agency banking, right? So I think from an agency banking perspective, they are also trying to create more job in the system. So for the agent, if you look at the different banks, they have like different agents across the different sector of the economy. Those agents do not typically have to have like a formal education before they can become agents. It's easier for you to start agents like in front of your house. So I think indirectly they are kind of creating like more jobs for people from that perspective.
Okay. What about the stocks? You like the stocks of some of the tier 1, tier 2 banks in the sector?
So what we've seen is, I think yesterday, ESI gained 32 basis points, and the banking sector was up 62 basis points. And I think what investors are basically positioning against is dividend-paying stock, right? I think for banks like some banks paid interim dividend during the period. Stanbic at the highest, paying 1.50 kobo dividend per share, and followed by Zenith, 30 kobo for those that have released so far. And Fidelity, like I think I can't even remember the last time Fidelity paid an interim dividend. Like this was the trend that we've seen compared to like their previous trend. So they paid 10 kobo, and as a result of that, we saw some positioning on the stock. The stock closed higher yesterday at 5%. And I also think when the markets also heard about the Stanbic dividend payments, there was also some ramping up on the stock too as well. Yeah, in terms of what we've seen so far. So it's more of positioning against dividend paying stock, basically.
Are you seeing any competition from the fintechs going forward? Is that more going to be more collaboration between the banks and the fintech players?
Yeah, so I think for me, like when we talk about fintech, right, I was going through a McKinsey report that was recently released, and I could see that there are some 4 key things that was highlighted, particularly when it comes to African fintech. I think the first was on scale and profitability, right? You want to ask yourself, like, we are cheaper compared to like the traditional equipment, but is this being cheaper? Is this sustainable over the long run? And the second thing is also the uncertainty in the regulatory environment. So from a regulatory perspective, you've seen, like, for instance, now Flutterwave, they had to stop like dollar virtual card, and they converted all our funds in dollar to naira. So, and this is due to the regulatory environment. So you see the impact of regulatory environment impacting these, the fintech, the disruptors. And the third thing is also seen is also like the third thing they mentioned was also managing scarcity, right? And that's particularly from a talent pool, right? The talent pool is not more of a local based stuff. It's more of a global thing. So you've seen like different people moving out of the country to be able to like move to get the higher job. So like there's that competition from a talent-based perspective, and also is the corporate governance, right? There've been like a lot of news in terms of like corporate governance, particularly for the fintechs. So I think the ability of them to be able to build internal resilience and to be able to resolve this issue is key. From a competition, to answer your question from a competition perspective, I think so far we still operate the bank-led model. I really don't see a competition from that perspective. I think it's going to be more of collaboration between banks and the fintech, because basically like everything still revolves around like the regulatory environment, and the regulatory environment basically determines how the fintech players, how they can be able to like disrupt, or how they can be able to like innovate, basically.
Great stuff. Okay, we're almost done. But a minute, if you can, I guess, can you give an outlook for the banking sector in Nigeria?
Okay, so in terms of outlook, I think we expect to see a margin increase, and this is coming from the fact that there's an increase in the rate environment, and the increase in rate environment is going to support the bank earnings. And I think on the other one is also intervention fund. So intervention fund was previously 5%, and for new intervention fund that's going to be created now 9%. So I think that should support the margins for the bank. On the downside, we expect the high inflationary environment, increase in funding costs, and also taxation as well. So one thing I forgot to mention was the fact that we saw an increase in taxation for the banks. And the increase in taxation is due to, the first is the modification in the Finance Act, which are led to an increase in tax, and also the expiry of tax exemption on government securities as well. So we expect that to affect the operating lines of the bank. In terms of loan, I think we expect a moderate loan increase, and this is coming on the back of there's an increased rate environment, right? So probably we'll see more of bank investing in investment security. And then if you look at Zenith, and if you also look at, I think Zenith and FPNB, their investment security grew more than their loan book, right, year to date. So you add more increase in investment security compared to like loan. And also the fact that customers are also going to be concerned of like there's an increase in loan rate, like will I be able to like take this loan? So there's going to be that pushback from clients as in terms of like taking loan. Another thing is also the fact that we're in a pre-election year, right? So there's also concern from the banks in terms of creating asset quality, since you know that there's going to be like a change in new administration, which will probably affect some sectors compared to like the others. So there's going to be that concern in terms of growing their loan book. I think the other thing is the other trend we might probably see is like M&A, because what we've seen so far is the fact that banks are trying to go into different subsidiary, like non-banking subsidiary, like pension and asset management. Access acquired First Guarantee, Access has proposed to acquire like First Guarantee, and they've recently received regulatory approval, right? And also Fidelity Bank doing like the UK acquisition stuff. So we expect that trend to also continue in the sector.
Great stuff. Great stuff, Babatunde. Great roundup there of the banking sector. Really appreciate that.
Yeah.
Thank you so much. All right, so we have come to the end of the show, but you can always catch the replay up on youtube.com/smooth981FM Lagos. And thank you to our guest, Babatunde Ogunleye, who's a equity research analyst with Stanbic IBTC. And of course, to Rotus, who's with us every single weekday. So Rotus, see you tomorrow, 6:30 for Tech Friday. Babatunde wants you to come back, so whenever you're free, pop on it.
No problem. Thank you so much. Thank you.
All right, the show continues. 7:30 will be time for Freshly Pressed. Good morning.